Okay, great. Good evening again, everyone. My name is Renat Yusufov. I am a partner at Bullpen, and today's talk will be about office development and things to watch out for as far as red flags in the underwriting as well as in the markets. So a little bit about Bullpen. We are a trusted marketplace for online work teams in real estate. We are a network of real estate professionals and freelancers where you can have certain consulting and advisory services on demand as needed. About myself, I have about 10 years of experience in real estate, a little over $1 billion in institutional real estate experience, AUM. I've worked most of my career out of New York, have an MBA from Columbia and a bachelor's from George Washington University. So with that, we will begin. So just going to lay out today's agenda first. The bulk of today's webinar will be revolving around a sample transaction we selected. It is a ground-up office development, and we'll go over some key highlights in the underwriting that will matter and usually fluctuate and usually make or break a deal. Following that, we'll have a brief summary of considerations to review for current underwriting, including leasing costs, trending of pro forma, as well as various geographical nuances for the markets today for office. And we'll wrap up with various current events that are hot topics in the office industry, specifically co-working space, demographic shifts in the workplace between generations, as well as opportunity zones. So with that, we will jump into the transaction. So the selected transaction here, it is a sample, it is redacted, it's not an official deal. It is an approximate 370,000 square foot office development, obviously Class A because it's ground up. It is currently in an A- D+ market, if you want to think of it as a sub-market of an A market or a Class A market or top 5 market, which is New York. The target for the strategy is an open space layout, high ceilings, shared amenities, generally aimed at attracting tech firms and co-working space, which are the two most in-demand tenants today in the office space. We'll get a little into that after a while. So I will start on the summary tab. Usually the way I like to start a model in underwriting is to have all of the key underwriting factors toggleable, so to speak, on one tab. Therefore, first of all, this is very presentable for an investor or a lender. And second of all, as you're discussing the key highlights and a high-level understanding of a pro forma as well as the capital markets, you can always adjust it in one go without having to jump around in the model. For the purpose of the webinar, I've highlighted in orange various aspects that we will go into detail that I wanted to highlight as very important factors in underwriting and that will affect your returns greatly. I'll go box by box downwards, starting with the primary metrics. Again, this is a summary tab that you can potentially even present to an investor or lender. And over here, pretty much 90% of the first questions you'll be asked will be presented in this blue box. That includes the total summary of the cost, project metrics, as well as investment return metrics, both untrended and trended, as well as levered and unlevered. Generally, you should kind of have an expectation for what each tranche in the capital stack will be looking for. Obviously, or more specifically, we'll get into it, but lenders will generally be looking for a certain debt yield. Investors will be looking for a certain IRR or a multiple, and we will get into each part of that once we're hitting the source and use. To the right of that, we have the untrended assumptions for the pro forma. And as you can imagine, these get trended across the board over the construction period and over the operating while you're still hitting stabilization and until you exit out of the transaction. Two key factors to highlight here right away. The first is vacancy and collection loss. Here it's left at 7%. This varies greatly, and in today's economy, it's not just by market, it's also by sub-market. I have a bias of knowledge towards New York, so I'll speak a little bit to that. Even within the island of Manhattan, your vacancy may range anywhere between the middle single digits, so around 6%, all the way to low double digits, around 12%, depending on uptown, downtown, and what part of downtown. There are entire rows, even in, so to speak, Class A submarkets that are empty retail or are a lot of high office vacancy. So this is definitely something worth investigating down to the wire of where the property is located, including in a submarket if it is part of a metropolitan area. The second important factor here are real estate taxes, which are becoming a growing concern depending on the state. California is notorious today for Prop 13, where this is becoming a growing factor for development projects, as development projects are assessed at value upon a transaction, meaning that once you build it, it is probably at its highest valuation, and you are trending it at that point by no more than 2% every year. So any new transactions that occur in California, for example, see a high increase in their real estate or their property tax upon acquisition or transaction. So something to be very cautious of both during the development as well as upon stabilization. Moving downward, we'll move to the financing assumptions. So this is the crux of how the capital markets and how the project is getting financed. For the purpose of this presentation, we're only doing senior debt and investment equity. We're going to skip mezzanine or any other middle products, but I will speak to them a little bit in terms of what risk they pose or what value they add. I'll start with the senior debt. In recent transactions, you're seeing that a lot of construction lenders are trying to scale back their risk. However, they obviously still have a lot of capital to put out given where interest rates are. So what you're ending up seeing for them to hedge their risk, they're actually lowering their construction LTC of how much debt they're putting out. They're also mitigating their risk by requesting higher debt yield or going in debt yields. So where you would normally see an 8% debt yield requirement previously a couple of years ago, today for that same market or even the same transaction, you're probably seeing closer to 9, 9.5 to 10. The really big topic in real estate today is obviously where interest rates are going. Rate spreads are increasing slightly as the index rate cap is decreasing. This is a trend that is widely foreseen to continue throughout until the election cycle at the very least. So something to be cautious again, as this rate decreases, lenders still need to achieve their yield somehow. So they're getting, as I mentioned, cautious on both the LTC and the debt yield. A little bit about mezzanine and preferred equity, or mezzanine debt and preferred equity. A lot of developers and sponsors are potentially getting more aggressive about capitalizing and leveraging. So they do go out to the market to find mezzanine debt or preferred equity. Just one point of comment about that, if you are going to be underwriting that kind of product, you do need to meet the HVCRE requirement, which essentially requires that at least 15% of the transaction is actual cash. A lot of developers are getting very creative about it in the sense of if, for example, you are submitting land, and we'll go into that in the budget later on, but if you are submitting land that you own that is entitled, that it technically counts as equity. So if at least 15% of your capital stack is either in land submission or in actual cash from either an LP investor or from a sponsor or a co-GP, you meet that requirement. So that is just one consideration to keep in mind if you are going to be using higher leverage products. To the right of that, we have the construction timing. Highlighted in orange here is the construction duration, which obviously has the biggest impact on IRR as far as timing. The longer the construction, and in this case, construction includes any pre-development as well that is required, anything horizontal before you go vertical. The longer your construction duration, the longer you're not seeing any cash flows or you're not stabilizing, which obviously dampens the IRR. Usually construction duration is underwritten anywhere between 1.5 years to about 2.5 to 3 years, depending on how complex the product is. Here we have 24 months or 2 years. That's from what I've seen generally standard for a product this size, again, 370,000 square feet. Again, just something to be cautious, adjusting this rate or adjusting this duration will have a very high impact on the IRR. The other aspect of timing is the relative time to stabilization. In this case, we are pulling a lot of those variables from the Argus. However, it also plays a big role depending on how hard it is to lease up. And obviously you have to really triangulate into that given how much free rent you're giving, how much you're spending in TILC. Moving downward, so this is the finalized sourcing use. We will go into the uses in a little bit once we're discussing budget next. But as you can see in your sources, I left the sponsor equity at 0. I'll get into why on the debt on the land basis on the next tab. However, in the meantime, you're seeing, as seen above, 50% debt, construction debt, and the remainder is filled out by various forms of equity. And finally, in terms of the residual sale analysis, the big factor, and lenders and investors, LP investors alike, are going to be challenging the residual cap rate that you underwrite. Something to be very cautious about. It's in a lot of transactions, especially transactions that are expected to exit 5 years or beyond. It's frankly anybody's guess. A good rule of thumb is underwriting about 12 to 15 basis points per year that you're holding the property. So for example, if today the cap rate is 4.5, you're underwriting 4.65 a year from now. So with that, this is the summary tab. As you can see, all the major toggles that will affect your returns are highlighted in orange or obviously in blue font. Usually you leave it this way because once you're going later on into your conversations with your partners, these are the toggles you'd probably be adjusting in your underwriting as you negotiate the returns. We'll move over to the budget next. So this is a pretty detailed budget. We don't need to, for the purpose of this webinar, we don't need to get into the individual line items. The reason for that is, generally speaking, depending on the scope of what you're building, you're going to need GCs or general contractors or a CM's point of view on this, and their write-up in terms of what they're expecting this will cost. They will probably give you the closest estimate, and that is the estimate you'll probably go to the lender or to the investor with. And obviously, it has to be defensible. As I mentioned, land valuation here is submitted at $10 million. That means theoretically, is that the GP or the sponsor already purchased the land, and they're submitting it for $10 million worth of equity. The question here becomes is who is actually agreeing to that value. So both the lender and the investor, similar to the cap rate, will have to agree to what the land is actually worth. Obviously, this will be defended through land comps in the area. However, even so, depending on how the underwriting shakes out, you'll sometimes run into a lender who will give you less or maybe even more than that as far as land bases you're able to submit. Obviously, the more basis you're submitting, it's essentially money that you've already spent, meaning you don't have to raise new money. So it's good news for the sponsor to have this value as high as possible. It also, as I mentioned previously, helps you meet your HVCRE requirements. As far as hard costs and soft costs, these individual line items for the purpose of this presentation are rounded. What you're essentially looking for today is a direct trade, meaning the sum of the actual hard cost, to be approximately $300 to $325 per foot. And you're looking for a total construction hard cost of around $400 to about $500 per foot. That's generally where most lenders are agreeable in terms of whether, how defensible your budget is. Obviously, within that, you have a couple of toggles that are, frankly, guesses, namely escalation, of course, any kind of contingencies, although those are generally pretty standard across the industry, anywhere between 5 and 7.5%. One value, and we'll get into towards the end of this presentation, what is happening towards construction costs, as they have been skyrocketing for a lot of areas, and they have been increasing for pretty much every market in the top 25 markets in the U.S. What ends up happening is the developer, who usually may be within the GP structure or the sponsorship structure, is actually getting squeezed out slightly. So where you may have previously seen a 4% developer fee, today you're seeing closer to 3.25% or 3.5%. And that is obviously done in order to lower the budget as construction costs are continuing to increase. Escalation, similar to what I just mentioned about construction costs growing rapidly. The estimate on where your escalations are going to shake out here, it's actually a little bit aggressive. Generally, depending on how long your construction duration is, if you're extending beyond 2 years, you may be really hit by a 5% or 6% escalation, meaning that your construction costs are actually going to be growing at this rate. For context, and I'll go into the details of it later, but for context, across the United States, construction costs have been growing at approximately 2 years annually. For various parts of the West, specifically California again, where there are massive labor shortages, you're looking at anywhere between 4 and 5% annual growth recently, and about 3.5% overall since the last recession. So the goal of the construction budget ultimately is to present what your return on cost is, which is a calculation essentially saying, okay, well, my net operating income once I stabilize, in this case, is $22.1 million. My construction costs are $236, so it's 22.1 divided by 236. You're arriving at around a $935. Generally for office products nationally, you're looking for a return on cost, depending on how aggressive the market is, anywhere between 8 and again, low double digits percentiles. So around anywhere between 8 and some of the more riskier, secondary, tertiary MSAs, probably closer to 12. So 935, this is Brooklyn, New York, for those of you who have noticed, is generally a safe return on cost to build to. Lenders will also look at this as their yield, obviously, based on the amount of money they submit. So they should be pretty comfortable here. Moving over to the next tab, which is actually the broken down summary source and use, as you saw in the summary tab. Here it shows money that has to come out upfront. Essentially, any kind of land or any land acquisition, or in this case, submission, as well as any financing costs. That includes any fees related to equity and debt, as well as any other closing fees. Ongoing funding generally relates to construction, as well as any kind of reserves. And here you have the total, as you saw on the budget tab, $236.9 million. The following tabs generally pull from the Argus. I do want to say one thing about Argus is obviously often debated in the industry, whether there's any kind of replacement for it. Argus is probably the most flexible tool for real estate, for commercial real estate, including office and retail. We often, at Bullpen, we often get requests to build some version of Excel. Just want to point out that it is doable. However, it has to be highly customizable for the specific thesis or the strategy that developer is particularly using. So with that said, as you can see, none of these are toggles. This is essentially becomes the engine of the model. I'll just zoom out so you see the high level picture. The numbers, frankly, don't matter for the purpose of this presentation. Essentially, you are not seeing anything leased up during the construction period as it calculates. And upon completion of construction, which as you can see happens in month 24 over here, you're seeing the lease-up period, which is the period to stabilization, followed by the actual stabilized period of the hold. You're calculating, and again, pulling from Argus in terms of leasing assumptions, in terms of free rent, in terms of role of tenancy. You're assuming what is going to be occurring every single month of the ownership period, and in terms of what your net operating income is upon exit. Obviously, this is important because you are exiting, or you're assuming that you're exiting at a cap value of 5%, as you may remember on the summary tab, highlighted in orange. The last tab, and this is generally the engine of the entire model. The funding schedule, again, I'll zoom out because the numbers specifically don't matter, but the vision does, is calculation of all the costs coming from the construction budget in terms of what month those costs are coming out, followed by all of the equity and debt, as well as any other capitalized products that you're using to finance the cost. And in terms of when that money is coming out, this obviously matters for things like the interest reserve, for example, because if you're drawing on your debt in month 4, that is money that you are beginning to pay interest on. Since you are not yet operational in your building, that interest is reserved back into the budget, and it is circular calculation back into how much money you need. Following that, you'll see your net operating income, and all of that together allows you to arrive at your total equity cash flow, both levered and unlevered, depending on if you're using debt or not. And as you saw, these returns here are presented on the summary tab for convenience, so you don't have to jump around the model. The final item is more for perception. It's not actually calculated into anything. It is the actual stacking plan. Obviously, investors and lenders will look at this to understand better in terms of what space you're leasing out, at what floor, et cetera. This begins to matter in the Argus, where higher floors will obviously get higher rent. In a lot of cases, they may get higher tenant improvement costs as well. So that is the summary of the model. I mentioned in the beginning, we're going to take questions at the end, but for now, we'll jump back into our summary analysis. And we'll jump into the considerations. So the two big items to really consider from the market perspective, construction costs. As I mentioned, they are growing 2% annually across the US on average. And as I also mentioned, California is probably seeing the highest growth. Here you have the top 3 markets within California, and you see their growth, 3.5% in San Diego, a little over 3 in LA, and a little over 3 in San Francisco. Interestingly enough, the #1 reason for growing construction costs is actually labor shortages. It is estimated that almost every market has not seen the labor workforce return to the same numbers as we saw before 2008. And this is actually why, because of this growth in value, and it is unknown to how long this continued growth will continue, lenders require a more depth explanation in terms of hard costs and soft costs, which is why you would have to have a GC or a CM really opine on the budget. The second is leasing costs, and this is usually a point of discussion when making an offer on new properties. It is also a big point of discussion underwriting ground-up development. To the right, you'll see tenant improvement allowances by market, and you'll see in the rightmost column the percentage change since 2013, so over 5 years. Tenant improvements specifically have grown by a tremendous amount. Generally speaking, even for secondary markets today, I'm seeing a lot of sponsors personally underwrite at least $50 a foot, which by comparison, it used to be anywhere between high 20s, low 30s. So you are seeing a lot higher TILC cost, which is definitely essentially becomes a construction cost and a leasing cost, which takes away from the revenue from the actual lease. In markets like New York, you're seeing, just by comparison, tenant improvements of $100 and upwards, depending on the building today. Next 2 items, pro forma trending. This is, again, something that may be a negotiation with the investors and the lender as you're presenting them a pro forma, as you're going out to the market to raise equity and capital. The general rule of thumb before used to be 3% growth on revenue, 2% growth on operating expenses. This has been challenged more often than not in my experience. We're seeing closer to 2.5% on revenue and about 2% still on the operating expense. If you're underwriting a triple net property, obviously they tend to be a little bit easier in terms of underwriting. I've seen less debating on just trending that at 2% growth. I would caveat that this is exclusive for a standard office development. In transactions where you may see the sponsor building basically a sale leaseback or building anything that's built to suit, that is a negotiation essentially with the investors of what kind of rent the sponsor will actually pay back upon completion of the project. As mentioned previously as well, property tax resets are becoming a greater risk depending on the location, depending on your local municipality. Something to be considerate of paying property taxes both during the construction phase as well as the pro forma phase of when you're actually operating. With all this in mind, there's obviously expectations to consider when you're going out to the capital markets, whether you are the sponsor or you are an advisor or broker representing the sponsor. Obviously, we know rates have been historically low. As I mentioned, probably expected to continue for at least the next year and a half. And you should be aware of how lenders are currently mitigating the risk of exposure to low rates. Obviously, they're incentivized to put out as much money as they can, but they're trying to minimize any kind of exposure that may occur upon rates going back up. So as mentioned, LTC thresholds or loan-to-cost thresholds are closer to 50, as you saw in the model. You're seeing debt yields now grazing double digits, depending on the market. Generally speaking, something like a top 5 market, New York, San Francisco, Boston, Washington, D.C., you're probably still closer to the high 8s, maybe mid-9s. If you're doing secondary markets, generally expect lenders to be comfortable around 10 to 11. For bridge loans, this story is actually very similar. They are targeting lower loan-to-value percentages as they're putting money out. Obviously, they're inheriting the debt from the construction lender upon the completion of the construction. And because of their exposure to the market, lenders are obviously getting a little more educated in terms of questions that they may have probably previously not been so ingrained in, including who you're targeting as tenants. I'll actually show a graphic in a little bit showing what kind of tenants are being pursued most aggressively today, as well as various local employment trends, local market trends, population and demographic changes. So here, as I just mentioned, you will see the various leasing sectors that are highly pursued. We're going to get into co-working, obviously a hot topic in a little bit, but essentially tech and co-working companies are the most pursued companies today. It is also some of the fastest growing industries, obviously. Finance and insurance, I would caveat the third one as depending on the market. Again, some markets are more prevalent with these kinds of tenants than others. Even in the Midwest, you're looking at something like, let's say, Minneapolis, a big tech hub. Some people may not know that, but it's a big tech hub. It's a big finance hub. However, it's depending on the sub-market within there, you're maybe targeting a different kind of tenant as well. A lot of millennials are moving out to that part of the country. A lot of millennials are actually moving out to Pittsburgh as well. That's a big story, a big tech scene that's happening there. And that is why lenders get generally more comfortable with certain secondary markets versus others, which didn't used to be a common factor in terms of how lenders would underwrite loans. In terms of geographies, I've mentioned it several times. So here would be a good graphic to kind of lay out where every market currently stands according to JLL research. As you can see, Class A markets have been getting the bigger portion of investment in office space recently in the recent years, obviously because they have been perceived as safer markets. Generally, some of them are getting maxed out, and you see both lenders and investors going to markets with higher yield, as you see in the counterclockwise turn. So the co-working topic of office space, it has been pretty impressive in its growth. It currently accounts for almost 2% of all office stock. I know that in New York, it's closer to 3%. Barring recent news, as some of you may know, WeWork is actually one of the biggest tenants in New York City. It's currently 71 million square feet across 40 U.S. markets, or the top 40. And it is predicted that this will continue to grow as both as far as landlord preference for a co-working space expands, also as far as Gen Z entering the job market and millennials continue to prefer flexibility in office leases. As mentioned, New York is closer to 3. Minneapolis, as I mentioned, is a big tech scene, a big healthcare startup scene, is closer to 2. You're seeing a big change in Pittsburgh happening as the art and tech scene is expanding there. And you'll also see that happening with the venture capital world, where they're actually leasing in co-working spaces as well, so they can be closer to their potential investments. And of course, the big elephant in the room as far as co-working is WeWork. A big shift in co-working tenants occurred as WeWork went to get their IPO. While the IPO has been widely viewed as unsuccessful, it's worth noting that WeWork essentially had to open up their books for the public to see. So a lot of landlords and investors, as well as lenders, now had an opportunity to look under the hood of how a co-working space operates and how a lot of them grow. So this will obviously affect anything like a Regus or any other competitor of WeWork as well, because they will be comped out to these kinds of returns or these kinds of revenues. And the last topic generally applies to every single asset class, arguably more to even multifamily than office. However, it is something to consider as far as the location of your product when you're going out to market to raise. There has been a perceived abundance of capital that is targeting opportunity zones. Some of them are even blindly targeting it. Just for reference, even the bigger funds, as you may know, are Blackstone and Brookfield. Those funds are targeting approximately a 12 to 13% return, which is significantly lower to any other LP return you may see in the office space. The amount is continuing to grow, even though the legislation is not entirely written out and filled out. One thing that if you are approaching opportunity zone capital, a question may come up, and just be prepared to find a way to answer it. It is that the legislation is not yet clear in terms of passing off capital. So for example, if you're not actually, or the sponsor is not actually exiting the property in say year 5 or 6 or the exit, you do need to recapitalize the fund, the opportunity zone fund at that point. So the question becomes of who is going to be buying into their yield, which is generally seen as lower than it would have been for a more market rate office development. So whereas they were looking for a 12% yield, a competitive product would have been looking for closer to a 20%. So you're looking to buy them out with somebody who's looking for a market return, even though that's not what they're going to be perceived as getting. The verdict is still out in terms of how this legislation will plan out, if they are going to extend the benefits to tax investors, and it is very likely that they would in order to incentivize that transition 5 to 10 years from now. So with that, we are actually done with our topics. I would love to open it up for questions. You're able to submit questions, so feel free to submit them and I will go through them.